Hi everyone, welcome to the first of three short videos with Jersey Finance. We're taking a look at the latest trends and challenges in the hedge fund world. Today I'm joined by Elliot Refson, head of funds at Jersey Finance. Elliot's role at Jersey Finance is focused on defining strategy and execution of marketing Jersey as both a domicile and destination for hedge fund and private equity management companies and funds. Welcome, Elliot. Thank you for joining us today.
Thanks, Roy. Good morning.
Morning. So today we're looking at the increasing importance of ESG in both for performing financial outperformance, but also there's been increasing pressure, I suppose, on ESG for various funds. I'll put this to you: is ESG a major factor now when it comes to manager decisions?
Absolutely so, and it's very clearly being driven by investors, and managers are responding. In a recent survey that we commissioned and released last week, all of the investors surveyed, as well as 61% of managers and their advisors, noted that ESG criteria will play an increasing role in fund domiciliation and indeed in the selection of service providers. Of the balance who did not agree, the overwhelming majority came from the US. So what this gives us is a clear and accelerating trend emanating from Europe and Asia towards ESG. And I believe that over time, we'll see that US managers who want to access those markets will have to comply with the investor requirements. I think we're starting to see this. Similarly, though, the issue has not yet filtered through to the jurisdictional level, but given the trajectory, we can expect this to be the next step, and we've started to see this in Europe with the implementation of SFDR, albeit in a watered-down version to what was originally planned. Within the report that we commissioned, we saw also that only 12% of interviewees believe that it would be beneficial for an agreed international standard of regulation for ESG, and that's fine. But as we've seen in other areas of regulation, it brings the potential for arbitrage. But I think that potential arbitrage misses the point here. And that is that the drive to ESG is being driven by investors, and particularly next generation investors. And it is a genuine and real requirement. And as we've seen with other areas such as trust and transparency or stability and governance, that those investors will demand jurisdictions that pragmatically and robustly meet their requirements. And given that Deutsche Bank expect that ESG assets are likely to increase exponentially to surpass over 100 trillion by 2028, there's also a significant business case to do so. And I think that this is a context within which ESG needs to be addressed from a jurisdictional perspective.
Yeah, I mean, absolutely. What, in your opinion, does the role of fund domiciles play in supporting the global ESG movement? Say, do you have an opinion on that?
Well, I think we've seen historically asset classes congregate in jurisdictions, and I believe that there's an opportunity for a single jurisdiction to come to the fore in the ESG space, and I believe that that jurisdiction could be Jersey, especially given our baseline of stability. I don't think there'll be any single conduit that will help achieve this. And so far, we've touched on the regulatory aspect, but ESG is so much more than that. It's a mindset. I think Jersey will come to the fore because of a combination of strategies based on the work and vision of our government, the recent consultation that the JFSC, our regulators, carried out, the Jersey for Good project led by Jersey Finance, which sets out a 2-year plan to accelerate our journey to a sustainable future leading up to 2030. And I think all of these things will collectively shape our credibility in the space.
Great stuff. And obviously the three letters themselves are very, very important when it comes to investor decisions. I mean, is the G element in ESG growing in significance at all?
I think we're in the early stages of a journey that will certainly see the E, the S, and the G split out over time, with each growing in significance, because fundamentally they are completely different things. But to your question, the G or governance is growing significantly, in part led by substance requirements, and I think this will absolutely continue.
Okay, and touching on that with the governance and substance requirements, to what extent are they influencing manager decisions?
In the first instance, it has to be available and you have to have the resources to meet the manager's needs. And in the second instance, the manager needs to have certainty that the rules are proportional and certain. From a Jersey perspective, I don't think that we promote our credentials in governance and substance enough. From a governance perspective, we have over 14,000 people who work in our finance industry, and they have deep and broad expertise in all classes, asset classes, and real world experience. From a substance perspective, the economic substance of companies taxation law, which was implemented in December 2018, was simply the codification of the prevailing best practices in Jersey. And I think it's very fair to say that we are very much leading the way in governance.
Great, and I'm sure, look, as you say, ESG is here to stay, and I think it's going to become an even more factor. And I completely agree with you that it becomes start being separated out even more so as we go into the next couple of years.